everyone. A very good morning. Thank you so much for attending our webinar today on financial statement compilations, reviews, and audits. My name is Jyoti Javeri, and I'm a partner with Chugh CPAs LLP in our Santa Clara office. Businesses may require financial statement compilations, reviews, audits throughout their life cycle to acquire new funding, qualify for insurance policies, evaluate internal procedures, and more. Today, our excellent panel will provide an overview of these assurance services and when your company may need them. If at any time you have questions during the presentation today, please feel free to enter them in the Q&A chat box below. We've got a great panel of experts to share their knowledge today, which includes Eunice Go, Partner CPA in our Los Angeles office, Edith Miranda Smith, Partner CPA in the Los Angeles office, Kisley Banka, Partner CPA in Santa Clara office, and Kapil Handa, Partner CPA in the Atlanta office. So now, without further ado, let's get started. Eunice, could you give us an overview of assurance services in general?
Thank you, Jyoti. Good morning, everyone. Assurance services are a type of independent professional service usually provided by a certified public accountant. Assurance services can include a review of financial documents or transactions, such as a loan contract. This review certifies the correct and validity of the item being reviewed by the CPA. Assurance services are defined as independent professional services that improve the quality of information for decision makers. Information risk is reduced by assurance services, allowing for better decision making. Businesses use assurance services to increase the transparency, relevance, and value of the information they disclose to the market and their investors. Assurance services are aimed at improving the quality of information for the individuals making decisions. Providing independent assurance is a way to bring comfort that the information on which one makes decisions is reliable and therefore reduces risk, in this case, information risk. Assurance services can be applied to risk assessments, business performance, information system reliability, e-commerce, and healthcare performance. Compilation, review, and audit are three different types of assurance services. CPA perform these services to provide credibility for your financial statements. Each offers a different level of assurance that the financial statements are in accordance with the financial reporting framework. The CPA obtains assurance by obtaining evidence. The level of assurance required varies. For example, the lender may require different levels of assurance based on the size of the loan, the collateral, and their determination of the overall risk. Back to you, Jyoti.
Thank you, Eunice. So now that we got an overview of assurance, statement compilations provide the lowest level of assurance. So can you please explain, Eunice, what is a compilation?
With compilations or compiled financial statements, the outside accountant converts the client's data into financial statements without providing any assurances or auditing services. Compilations allow companies without an accountant to have financial statements prepared by an outside professionals without the higher cost of reviewed or audited financial statements. Generally takes 1 to 2 weeks. This is the most basic accounting service, a cover page written by a CPA that accompanies a set of basic financial statements. Any accountant can prepare a compiled report. It's called a compiled report because accountants generate it by compiling your financial records into a widely accepted financial statement format. Having a compiled financial statements show external parties that you have an association with a CPA, but doesn't offer a deep level of assurance on the accuracy of the financial statements. Unlike an audit engagement where auditors are required to provide an opinion on the fairness of the financial statements, a compiled engagement does not require an accountant to provide an opinion on the correctness of the financial statements. Also, it does not provide assurance that the company has complied with the accepted accounting principles. Therefore, the accountant engaged in a compilation engagement is not required to use analytical procedures, review procedures, or inquiries, or engage in other audit procedures. A compilation is more basic report than an audit because the information is neither substantiated or confirmed by outside sources. A compilation is known as an audited report. Your company accountant or an external CPA can prepare this document, but neither needs to verify that it meets any standards. However, CPA must have sufficient industry-level knowledge of the client. Since the CPA does a cursory check on basic features of financial statements to write the compilation letter, no special preparation is required on your part. A compilation statement is the least expensive of the various audit types. It is preferred by entities whose key stakeholders approve such form of engagement. Back to you, Jyoti.
Sure, thank you, Eunice. So what exactly does an accountant prepare during a compilation?
When performing compilation, the accountant should prepare adequate documentation which includes the engagement letter, financial statements, and the communication with management regarding significant issues identified during the audit. A compilation report should accompany the compiled financial statements to indicate that the financial statements are representation of the company's management, have not been reviewed or audited, and therefore the accountant does not offer any opinion or any assurances on the financial statements. Back to you, Jyoti.
Sure, Eunice. Now that we understand the compilation process, what documentation can businesses expect from a compilation and what does it all mean? Can you please explain, Eunice?
Engagement letter. The engagement letter is an agreement to provide compilation engagement to a client, and it defines the services to be performed by the professional accountant or auditor and the compensation to be paid. For engagement letter to be legally binding, it must be signed by the authorized representative of both service provider and the client. Some of the information contained in an engagement letter includes the services to be provided, the amount and timing of payments, specific due dates, how the parties can terminate the contract. Most of the engagement letters will state that the accountant will prepare and present the financial statements and provide a compilation services. For financial statement, when an accountant accepts the audit engagement terms, he is tasked with preparing and presenting the financial statements with client's company. She's required to follow the accepted reporting framework, which is the IFRS or US GAAP, when preparing the financial statements. Depending on the terms of the engagement, the accountant may require to prepare a single financial statements or a set of key financial statements. The financial statements can cover a short period such as a month, quarter, or an annual period, depending on the requirements of the management. The accountant may include a reference to the compilation note at the bottom of the financial report to notify the reader that a compiled report exists. Back to you, Jyoti.
Thank you, Eunice. Kapil, as we hear from Eunice, the entire compilation process, the next when it comes to the compilation documentation, your accountant will provide a compilation report. So Kapil, can you throw some light? What does that entail?
Sure, Jyoti. Hello, everyone. Coming back to compilation report, it's a one-page report which again addresses the client and it also addresses the period which is covered under the financial statements. One of the most important thing is it specifies that the management is responsible for the statements, and as an accountant or CPAs, we are not really giving any opinion in the authenticity or the clarity of the financial statements. We just compile it based on the information that the client provided. And one more point, it also states what are the standards. In this case, they are the standard statements for accounting and review services, which are issued by American Institute of CPAs. It mentions those are the standards that we followed in complying that compilation report. Back to you, Jyoti.
Thank you, Kapil. So now everyone here would be very eager to know, when will businesses actually need to get a compilation?
So again, compilation is basically, sometimes what happens is we deal with a lot of smart clients. They are starting a startup. They know where they are bringing the money. The money is coming. Who is funding it? All that is done. They can write and pay the invoices. But compilation is really kind of making all the data in a more presentable manner so that a layman can understand. So in this case, those owners or the founders can know, okay, 100,000 is what I put in the business, and this 100,000 is coming from my own funding money, or I borrowed it from a friend, something like that. But then they are able to see the financial statements in a very simplistic manner. And that's one and the foremost thing, so that the owners can actually make sense of the numbers which are just all over the place, and that can be presented in 1 or 2 pages. Secondly, sometimes the once the clients are kind of making business, they're growing, they may not need as much money to kind of get into the next step. So if it's not so much high financing which is needed, a lot of the times, the banks are okay with the lower level of assurance services, which is compilation report, just to see where the numbers are. They are not really checking exactly the authenticity. They just want to see the presentation of the numbers. At that time, at the lower kind of a financing model, that's where it is needed. In addition, sometimes clients are really looking for a forecast, or maybe they are looking for some projection, considering some acquisition. And lastly, they sometimes want to know, okay, what is the profitability of their products? Are they making money? What's their gross profit margin? What is the net profit margin? Just to kind of see if whatever they are doing is actually going towards some kind of a productive manner, and putting all the things together on a piece of paper. That's how it works in the compilation report. Back to you, Jyoti.
Perfect, Kapil. Thank you so much. Now that we have like a gist of the compilation report, moving on to the next assurance service, like a little more higher and more detailed work, which is the financial statement review. Kapil, what is a review and what does it entail?
Sure, Jyoti. Again, review is a step up from compilation. As my colleague Eunice mentioned earlier, there are three types of attestation services, and review is really the middle ground where the banks, kind of are okay with that service. And what that really means is we are still not really vouching or testing the balances when we are reviewing the financial statements of a client. But however, we are doing the analytical procedures, and we are also making a lot of inquiries to the management. So just the basic difference would be, in compilation, a client is sending me the information, I'm jotting it down and just giving it back to my client in a presentable manner. But in review, actually, I'm asking the questions exactly what, if they are doing something, I'm comparing the numbers from this year compared to last year. Revenue is up or down. What's the reason? The cash is sitting this down from last year. What are the plans to fund their operations going forward? Are there any going concerns? So basically, just not kind of just looking into the number game, but also trying to understand the overall picture. Where are the business getting into the right direction, and would they be able to survive, and maybe giving an information or maybe some kind of a data points to the client, what they can plan ahead given where their numbers are, which they may not be aware sometimes. But once we come in and review the statements, we can tell them, what, your vendors are so much charging you compared to other people, or maybe the debtors wherever you are selling those people to your clients, maybe some of those clients, I as an owner or founder might be thinking, I'm doing a great business, but those clients may not be paying me for 8-9 months. So again, kind of not just only putting the numbers together, but maybe partnering with the client and helping them through their journey to see how they can survive and thrive. that's what we really do in the review statements. And of course, one and the foremost thing is all these reviews again are kind of overseen by AICPA, and we need to follow the guidelines, which is again generally separate accounting principles that we while we issue the review report. So those are the basic differences, Jyoti, that we really keep in mind. But again, review is again driven by the banks, typically wherever they need. So whatever the banks need it, the client comes back to us and then we take it from there. Back to you, Jyoti.
Thank you, Kapil. So could you give us some idea as to some questions your reviewer may ask during the financial review process?
Absolutely. I think first thing I want to touch is, typically when a client comes in, they say, we want a review. They may not even have heard this word review, but because the bank needs it, they come to us, and then they ask how long it takes. Typically, if it's a decent sized company, we have a very good turnaround in our team. We can just, from the day we sign the engagement, we are able to turn around and give the review back to the client within 2 weeks. And typically, what it entails, again, coming back to the same point, we ensure that the data is making sense. We ask questions, we compare the data from prior year, we compare what are they expecting in the future year. We also ask the management, what exactly is the plan to move forward, any particular thing that they are really worried about, anything that they might want to discuss about the internal controls. Again, internal controls is not really something we touch upon when we are doing review, which will be covered later by my colleagues when they present the audit. But those are the typical questions, that we kind of look into and just ask the management just to make sure they are kind of stepping up and improving the quality of the financials, and more people, more investors, more outside parties can rely on those numbers. At the end of the day, I might be saying anything, but the more authenticity I can give, better marketable my client is, and they are able to raise more funding. And of course, at the end of the day, they can grow more and employ more people. That's all from the review process. Jyoti, back to you.
Thank you, Kapil. Now that we understand the process and we know that some test would be performed on the business processes, Edith, would you help us understand what are these tests and what does it include?
Hi, Jyoti. So in addition to what Kapil has mentioned, so the reviewer has to have a better understanding of the business processes. So they have to perform tests to determine if they are in place and operating correctly. So for example, a reviewer may ask to see several vendor invoices, the payment receipts, and then they would match it with their internal tracking system and accounting records themselves. So also, a reviewer may trace inventory movement into sales totals and evaluate the trends. It could be month over month. And also, they can confirm balances directly to a third parties if the third party is maintaining the inventory of the business. So like Kapil said in a review, it's more of analytical procedure. So a reviewer can conduct a ratio analysis. This is a quantitative method of gaining insight into the company's liquidity, operational efficiency, and profitability. So by studying the financial statements, such as the balance sheet and the income statements. So typically the accountant will use the historical data by comparing the to previous year, or they can use a forecasted data or based on their expectation, or sometimes they would use the industry results. Also, reviewer CPA may inquire about the procedures on how the transactions are being recorded. Also, so when they do these analytical procedures, if there is inconsistency, they can investigate on the findings, why it is inconsistent with the prior years, or whatever you have forecasted. Also, if there is unusual or complex transactions that may impact the results of the business, they can investigate further on that. or typically if there is a significant transactions towards the end of the accounting period, they can also look into that. Let's say that it's a calendar year end, so they may look at the last 2 weeks of the December transactions before the closing. And also, a CPA can also follow up on questions that arose during the previous reviews or audit. And also part of the review process is for a CPA to look into or inquire about material events that occurred after the year end, or after the date of the financial statements. And also part of the review process is if there is any communication with regulatory agencies like IRS or Franchise Tax Board. An accountant or CPA can review those communication from these regulatory agencies. They can also review the management reports that is prepared by the accountants, or who audited or reviewed their financial statements into the prior year. So in a review engagement, Jyoti, the CPA will issue a formal report that includes a conclusion as to whether, based on the review, that he is aware of any material modifications that should be made in the financial statements in order for them to be in accordance with the applicable financial reporting framework. So that's Jyoti, typically is the review process.
Sure. Wonderful. Thank you. Thank you so much, Edith. So now, when would businesses actually need to get a financial statement review?
Typically, so when the business grows and they need a larger or financing or more complex financing and credit, so they request for the review, and this is intended to be submitted to the lenders or outside parties to provide them with a basic level of assurance of the accuracy of the financial statements, because these lenders or other our outside parties will be relying on this review. So back to you, Jodian.
Sure. Now let's move on to the most in-depth assurance service available. Now that we heard about compilation review, the next is audits. What exactly is a financial statement audit?
So Jyoti, audit it involves a thorough review of each item on the financial statement. So it also entails internal control testing if it is working effectively, so that to make sure that the financial reports are accurately reflected. So an audit is the highest level of financial statement service an CPA offers. An unqualified, which is a clean audit opinion, provides a financial statement users with a high, though not absolute, level of assurance that the company's financial statements and related disclosures are presented fairly and conform in all material respects to generally accepted accounting principles.
So now, because hearing out you, Kapil, Eunice, we understand that the audits are more detailed than compilations and reviews, which would mean that it would take more time. So what timeline can companies expect out of an audit?
So typically, an audit is scheduled for 3 months from beginning to end, but it depends also on the size of the business. So let's say if it will take 3 months. So 4 weeks we spend on planning for the audits. So that's when we do these comparative, these analytical procedures. And then we do the 4 weeks of field work where we do our audit testing, do this sampling. And then the last 4 weeks that's when we compile or prepare the audit report. So that's basically like it will take three months. It could be less. It depends on the size of the business. Yeah,
Got it.
Jyoti.
Got it. Thank you. Thank you so much, Edith. Now moving on to understand like the types of audited financial statements. Kisley, can you help us understand what type of financial statements might your auditor might evaluate during the audit?
Thanks, Jyoti. Hello, everyone. There are primarily four types of financial statement that are part of audit report: balance sheet, cash flow statement, income statement, and statement of shareholders' equity. Balance sheet generally details about your company's assets, shareholders' equity, and liability at any given point of time. The cash flow statement provides summary of cash activity during the year. For example, how much cash was generated from operating activities, what amount is spent on investment activities such as purchase of fixed assets, and if company generated any external finances or equity, and that is categorized as a cash flow from financial activities. Income statement, also known as a profit and loss statement, it tells you about the performance of the company in terms of how much profit or loss company has generated during the year. Lastly, the statement of shareholders' equity. The statement of shareholders' equity provide a snapshot of the capital structure changes during the year, and it also tracks the retained earning of the company.
Got it. Thank you. Thank you, Kisley. So here we understand that there are three main phases to audit. Could you please provide a broad overview of the audit process for the financial statements, Kisley?
Yes, the audit process generally involve a team of audit team, and that includes one senior auditor plus one or more audit staff that will be assigned to handle your audit. As a part of initial audit process, first we understand organizational structure and discuss internal procedures. A CPA auditing a financial statement usually move during three stages. First, industry research and risk assessment. For proper auditing, we learn about not just about your company, but also the industry and competitors. With this knowledge, they may better be able to identify risk that could affect your financial statement accuracy. Second, internal control testing. We test the company's internal control to understand the process for employee authorization, delegation of responsibilities, and asset protection. And depending upon how strong or weak internal control process are in place, we plan for the next phase of the audit. Then we go through the statement verification. The following first two stages, we will verify each and every item on financial statement. For example, if you are checking your account receivable, then we may reach out to your customer and ask them for balance confirmation if they are matching with what we are showing in our books. So,
sure.
Continuing with the audit process, in addition to checking and verifying items on the financial statement, we ensure company is following US GAAP, which is generally accepted accounting principles. Internal controls are reasonable. Statements are reflecting the reality of organizational transactions. Overall, the auditor's job is to inspect your organizational financial statement with attitude of professional skepticism. And after all, we attest your company's financial statement that it fairly represent the financial position. Lastly, Jyoti, one more important thing I would like to clarify. Auditors do not search for the fraud. They will not fix and clean your books. They are primarily the company's responsibility, but the auditors may provide a very useful recommendation for your organization accounting principles and policies.
Got it. Got it. So I do hear you, Kisley, and I do understand that audit is a more detailed procedure, and there will be a lot of testing done on the financial statements and the transactions as part of the process. So could you throw some light on what these tests these auditors actually perform?
Sure, Jyoti. So well, generally we ask for a lot of information from the client for audit, and that includes, besides financial statement, general ledger and detailed transaction. And as a part of substantial procedure, we go over the general ledger, we pick up some sampling, and we go in much deeper detail and get the information from the client and find out they are accurately recorded in the books and showing a proper presentation in the financial statement.
So overall, what should companies expect to receive as part of their audited financial statement, Muslim?
So after we are done with our basic verification, inspection, and internal control assessment, we are ready to issue audited financial statement. It's a package that could be somewhere 30 to 50 page of package, and it broadly involves three parts. One is first and most important is opinion letter. I'll come back on opinion letter in a moment, but following opinion letter, financial statement that we just discussed, and following his financial statement, we provide notes to the account. In notes to the account, we describe the accounting policies, such as how the company is recognizing revenue, if they're following the accounting standard, and a lot of other disclosures. For example, any contingency and risk on financial statement, and so on. Regarding opinion letter, opinion letter is the one that CPA sign. There are four type of CPA financial statement opinions. First one is unmodified opinion. This is a very standard audit report that you guys see. Second is qualified opinion. So this report has some exceptions. With those exceptions, we are issuing the qualified opinion. Third one is adverse opinion. This opinion signifies that your financial statements are inaccurate. And fourth one is disclaimer of opinion. If the result, this result is not an opinion but lack of one, it basically signifies that you have not given your CPAs the access or information or time needed for completing an audit.
Thank you, Kisling. So now that we understand this whole detailed level of process and procedures done for audit, what are the instances when a company may actually need a financial audit? Could you give us some context of these situations when companies would need a financial audit?
Sure, Jyoti. In United States, audit is not mandatory for private companies. It is mandatory for public companies, and that is governed by SEC. SEC regulations require the public companies to get the books audited. However, there are many occasions when audit could be required. Maybe investors are asking for the report. Nowadays, a lot of banks, they ask for the audit report for line of credit or loan purpose. Some of our clients are affiliates of a public company in other countries, and in order to consolidate audit report in their own country, they would require audit report for US subsidiaries. If there is suspicion of fraud being committed within the company, the management could look for audit report so that they can discover the problem and set their process or internal controls. Many businesses also bid on government contracts, and those contracts requires audit report. A lot of companies, they go for M&A transaction, and the buyer or seller, they would require the audit report. Uh, Public companies are required to provide financial statement to their shareholders, as we discussed earlier. Even if not required, many companies choose to get the books audit performed anyways, because they can yield valuable benefit. For example, audit can help a company ensure the accuracy of financial information, and can help identify the weakness in internal control and way to improve those internal controls.
Thank you, Kisle. So this pretty much brings us into our presentation. I'm sure everyone's got a gist of what a compilation is, what a review is, what is an audit, what are the processes involved. So this was just to give you a complete idea of all the assurance services that are provided for the financial statements. We do have still some time. If you guys have any question, please feel free to put your questions into the chat box. I can take those as they come in. So Kapil, I have a question. Can we change the type of attestation service after we have signed the engagement?
Sure, Jyoti. I think this is the question we get asked sometimes, just a personal experience, as we were engaged with one client for a review services, and in the midway, they felt, they would really want us to kind of do the testing of each and every account. And then as part of review, as we touched base earlier, we were just going to go and stick with the analytical procedures and inquiries of management. And then they say, you know what, you can just do the testing and then we will just make it as an audit. So yeah, as a practical experience, we cannot do that. So in that case, what we did is we had the client sign another engagement letter. We pretty much then again went on and then did the audit from the beginning. So that again, we might be able to use the basic information, but once the client wants to move up or down from an attestation services, we really need to sign a new engagement letter specifying the exactly what is the service that the client wants.
Got it. Thank you, Kapil. There's one question which has come up. I think Eunice, probably you may want to address this. They want to know what are the examples of attestation services besides compilation, review, and audits?
Besides compilation, review, and audits, we also do agreed upon procedural engagements, reporting on financial forecasts and projections, reporting on pro forma financial information, compliance attestation, and reporting on entities' internal control over financial reporting.
Got it. Thank you. Thank you, Eunice. Another question which people have is, when does a reviewer perform additional procedure on review process, like investigating on the account or a transaction? Edith, would you be able to help us with this?
Yeah, sure, Jyoti. We said earlier, like Kapil and I has been pointing out, review engagement. It is mostly interview or inquiries and also analytical procedure. But if once we do this analytical procedure and there is some inconsistencies with what we have expected or what we have forecasted, and also based on the historical, then we do an investigation. So we look into these findings, why it appears to be inconsistent with the whatever we have forecasted. So let's say if we compare from last year to this year, and then we see that there is a big drop in the revenue. So we ask the client, we investigate, so why there is a big drop in your revenue. So we look further into that. So they can tell us that, oh, we have lost a client and that's what happens. Or so this happens when, like I said, there is inconsistencies with whatever we have forecasted or based on historical data.
Got it. Sure. And then even, is it mandatory for review or audit requirement that we have to every year, like filing annual tax return? Is it like mandatory? Kapil, can you throw some light on that?
Absolutely, Jyoti. Yeah, that's a question we can get asked quite a few times. So again, fortunately, in the US, if you are not a listed company, which means you're not listed in US stock exchange, you don't have to get an annual audit or review. It's again, the audit or review is typically, kind of driven by the lender in the US. That's what we have seen. Or maybe, as Kisley touched upon earlier, maybe there's a subsidiary of a foreign company and that's what they want. But again, it's not a mandatory requirement in US unless you are listed company. But yes, if you're listed, the answer is yes. But if you're not listed, which is majority of the small businesses in US, you are not required to get an annual audit or review.
Perfect. That explains, Kapil. Thank you. I do see some basic general questions. They would want to know, what is a material misstatement? Anyone would want to take it?
I can answer that, Jyoti. Material misstatement is when there is an information in your financial statement that is sufficiently incorrect, and it can impact the decision or economic decision of someone who is relying on those financial statements, like the bank. So if the client has this covenant that they have to meet, so they can be current on their loan, they can manipulate or make some um, changes on their financial statements. They can, or if they are wanted some investor to invest on their company, they can inflate their revenue. They can do that. So once they do that, this is now become a material misstatement. So for us auditor, that's what we are making sure that there's no misstatements on those financial statements. So we provide the readers reasonable assurance that there is no material misstatements on the financial statements.
Got you. Got you. Thank you, Edith. Even just very curious now, are all the results of these audit public? Anyone, do you know that are the results of these audit processes, are they public?
I think if it is a public company, it will be available to the public. For those a private company, I don't think so.
Sure, got you. And one last question that I see here is, what is the main difference between a review and an audit? Anyone could take this.
Sure, Jyoti, this is Kapil again. Again, I think we touched upon, review is a very kind of a inquiry and analytical based, where we are coming in and kind of seeing at a very big picture level, anything that needs to be fixed can be fixed, and really helping client understand where they are going and where they need to get it fixed to comply with the US GAAP, and not really taking or vouching and or confirming the balances, which is the case in audit, wherein client is giving me the numbers, but I'm actually confirming those balances with third parties. My client might be saying, $500,000 is owed to me by my customer. We say that's fine, but then we independently send those confirmations to those clients of and the customers of the client, and then really vouch for it. Take the example of bank. Bank is the one where, if typically what we have learned in audit, that's the reason there's a lot of segregation of duties where people can really manipulate. So if there are 2 or 3 people in the organization, and if they kind of, form a union, they can really manipulate the things. And that's the reason, first and foremost risk that the financial statements would have is confirming the bank balances. And in audit, we definitely confirm those balances, which in review, it is not required. I may still do it as a reviewer of the financial statements, but in audit, it's my part of my job, part of my duty, that I need to confirm the bank balances. Again, if I'm a third party who is trying to fund me, who is trying to fund the client, I really know that if the financial statements are audited, it is the highest assurance possible to kind of get from the client. Again, it doesn't mean that tomorrow something cannot happen to and there might be some fraud that entails, but still it's one of the best highest assurance services that is available out there, which helps the client at the end of the day.
Sure. Thank you, Kapil. I'm sure this whole seminar would have given a good gist of idea of what compilation, review, and audit is. People would now be able to make an informed decision as to would the company really need a compilation, review, or an audit. So thank you so much. And thank you all so much for joining us today. For further questions, or if you need to schedule a consultation, please send us an email at info@chugh.com. Or you could also email any of our presenters directly using their contact information, which is on the screen. We have live webinars each month and our COVID-19 resources for small businesses. Please visit our website at www.chugh.net to register for any of the upcoming webinars. We also recommend subscribing to our YouTube channel, Chugh LLP, for great new business content each week. Thank you so much once again for joining our webinar today. We wish you a safe and a happy week ahead. Thank you.